Hi, my name is Jim, and I was retired. This week, as expected, the Federal Reserve began the process of tightening monetary policy with a quarter point increase after 2 years at the zero lower bound. In this video, I'm going to ask, is a quarter point really tightening? Stay tuned. Like many retirees, I'm very concerned about the high inflation we're experiencing, especially since savings and bonds are yielding so little fixed income. It's one of the consequences of having a monetary policy that's bound at the zero level. I'm afraid the Federal Reserve has left its monetary policy too low for too long. The most recent reading of inflation with the personal consumption expenditure, PCE, that the Fed likes to use, was 6.1% in January, and that's likely to be higher in February. Since the target rate is 2% PCE, they've overshot it by threefold. A few videos ago, I shared the perspective of Milton Friedman, who said inflation is always and everywhere a monetary phenomenon in the sense it is and can be produced only by a more rapid expansion of the quantity of money than in output. While many are putting the blame on the Russian invasion of Ukraine or the pandemic or fiscal spending in response to that, the real issue is too much money in the economy, and that rests squarely with the Fed. Even Fed Chairman Jerome Powell said before Congress recently that, quote, hindsight says we should have moved earlier, but there really is no precedent for this. The problem is that the Fed seems to be following precedent by following the same game plan that they followed the last time they tightened monetary policy. That began in December 2015, a month into my forced early retirement, so I was keenly aware of where the economy was. That was a series of slow and steady quarter point rate increases that ended in December 2018 at less than 2.5% effective Fed funds rate. So they didn't raise it much. For this campaign, analysts are predicting 6 to 8 increases this year. But if the Fed sticks to a quarter point at each regularly scheduled FOMC meeting, they only have 6 more meetings to go. And that would only take them to about 1.75% in the Fed funds target rate. That's less than where they are for consensus. So maybe one of those increases is going to be a half a point instead of a quarter point. But still, it seems too slow, too steady. That's not really tight monetary policy, particularly with how hot inflation is running. The second problem I see is that the Fed always seems to move much slower than they anticipate. Let's go back to that last tightening process that began in December 2015 and see how they predicted Fed funds rates would go over the next couple years and what actually happened. For instance, this is the dot plot from the Summary of Economic Projections in December 2015. Each dot represents where a Fed policymaker thinks the Fed funds rate should be for appropriate monetary policy. And as you can see, a lot of these dots are in the 3 range, particularly in the 2017 and 2018 range. Yet, here are the Fed funds target ranges, the lower and upper bands for those same years. And as I said, the highest the Fed funds rate went in December 2018 is 2.5%. So here I superimposed the chart from FRED, the St. Louis Fed database, on top of the December 2015 dot plot. And as you can see, the policymakers clearly overestimated where they would go in the next few years. So now here is the most recent dot plot where the Fed policymakers say the Fed funds rate will go during this tightening campaign. This is from the Summary of Economic Projections just released this week. Now, I'm going to show you this different version of it from Bloomberg that cleans up the dot plot, tightens it up a little bit, and includes this green line here of the median value of the dots. And as you can see, it's at about 1.9 for this year and goes up to about 2.75 for the next 2 years before returning to closer to a neutral rate around 2.25% in the longer run. Will they overestimate this? Will the real projection be closer to where the market has it? This gray line here is the Fed funds future, the latest values. And they clearly think that the Fed overpromises. Keep in mind that when the Fed last tightened back here, that PC inflation was 0.4%, a fraction of its 2% target. And now we're at 6.1%, threefold from its 2% target. Clearly, this may not be the right path to follow this time round. Given this comparison to where inflation was for this last tightening process, and they maintained it close to the 2% target. It got as high as 2 and a fraction here, but it kept it and then kept it below 2% here. Then we hit the pandemic and everything went to hell in a handbasket. Since then, inflation has just taken off and we're now 3 times the target rate. So really, is this the same path we should follow? So where is Paul Volcker when you need him? By the way, this is from the Cleveland Fed, and they take a look at some common systematic rules for monetary policy, including the well-known Taylor rule. And they look at where the rate should be based on those simple rules. And as you can see, the Taylor rule originally, we would be about 8% in the Fed funds rate. Even if you took the median level of all of these different estimates that they look at, you'd be at about 3%. So a quarter point is not really tightening, is it? So the other challenge in following that same path as 2015's tightening is the size of the Fed's balance sheet. Whereas the Fed began with a balance sheet of about $4.5 trillion after the financial crisis. That's where they had bloated up the balance sheet to. And they were able to do the tightening process and then whittle that down to about 3.8 trillion before the balance sheet exploded again with the pandemic recession. And we're close to 9 trillion now in the balance sheet. The last time the Fed tightened policy, it switched from quantitative easing to quantitative tightening, but the policy makers waited until the Fed funds rate was over 1.5%. And as you can see that's here. This is when they began quantitative tightening, when they were about 1.5% on the Fed funds rate. By the way, this is one of the unconventional tools that the Fed began to use after the financial crisis of 2008, whereas the Fed funds rate uses the trading of the rate the banks charge each other to influence other rates in the economy. Quantitative easing means the Fed is buying treasuries, agency debt, mortgage-backed securities to put dollars into the economy. And quantitative tightening then sells those same assets to take dollars out of the economy. In the last tightening campaign, the Fed was able to use the quantitative tightening to whittle down the balance sheet from 4.5 trillion to about 3.8 trillion. And this time, they're going to begin this process with a balance sheet that's about 9 trillion. The FOMC statement this week said that the committee expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities in the coming meetings. folks, the next one isn't until the first week in May. And if they roll out a schedule to wait until the Fed funds rate is over 1.5% again, they're not going to begin to reduce the balance sheet until the end of this year. So I hope they change this. Recent research by the Kansas City Fed suggests that the Fed may want to start sooner with the quantitative tightening. Whether the FOMC reduces the balance sheet before raising the Fed funds rate or vice versa may affect the shape of the yield curve, with consequences to financial institutions. Drawing lessons from the previous normalization in 2015 to 2019, we conclude that normalizing the balance sheet before raising the Fed funds rate might forestall yield curve inversion and in turn support economic stability. So I don't know. I'm hoping that they have learned the lesson from that last attempt at quantitative tightening and do a better job this time. And so this paper argues, and others have made the same point, that if the Fed begins to do the quantitative tightening at the same time as the Fed funds rate or a little bit faster than the last pace, then they may be able to avoid flattening the yield curve, which ran into problems in the 2018-2019 timeframe last time. So I'll conclude with my standard warning. I'm not an economist. I'm not a professional. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. See you next time.